Hello everyone, this is Corey Mitchell with TradeThatSwing.com, and in this video we're going to look at the historical average returns of the Russell 2000 index, and really in comparison to the S&P 500 and the Nasdaq 100, because these are sort of the main indicators or the main indexes that people watch. And so we want to look at how they compare, and then we can also just look at the direct returns from the Russell 2000. So over the last 20 years, the Russell 2000 has underperformed the S&P 500 and the Nasdaq, so we'll look at that in a little bit. But over a slightly longer period, since 2000, IWM has performed pretty similarly because it didn't drop as much in the 2000 stock market crash. So that's just something to be aware of. Anytime we look at averages, or we're actually in this video looking at annualized returns, I use the word averages because that's what most people think of when they're, what's the average return of the S&P 500. But really, when you're looking at averages, you're looking at annualized return, and an annualized return is just slightly different than an average. An average return would be you'd take the start and the end, and then you'd average out all those, the start of the year, the end of the year, how much did you make that year, and then you'd average each of those years together to get an average. Whereas the annualized return looks at your starting point and your very end point, so that could be 20 years later, 25 years later, and then calculates what your return would have been each year to get to that exact value that you're at 20 years or 25 years later. So it's a slightly different calculation, and it ends up where that's your exact return for that period, whereas an average return, if you sum them all up, you probably wouldn't end up with the exact same ending value. So the annualized return is a little bit more accurate. A little bit about the Russell 2000 index. It is composed of the Russell 3000 index, includes the largest 3,000 companies in the US. The Russell 2000 includes the smallest 2,000 companies of the biggest 3,000. So you could think of it as the smallest 2,000 companies of the biggest 3,000. So it's not like super tiny companies. It's a lot of them still are quite sizable, but you're not going to have any of the. You're basically excluding the largest 1,000 companies in the US, and then the Russell 2000 is your next largest 2,000 companies. So it's generally considered a small capitalization index because you don't have any of those huge companies included in it. The Russell 2000 index launched in 1984. The Russell 2000 ETF, or at least the one we associate the most with the Russell 2000 ETF, IWM, does lots of daily volume every day. It tracks the Russell 2000 index, and it launched in the year 2000. So here are the annualized returns. Going back to 2000, when, this should say as of April 17th, because I just updated this, as of April 17th. You can see updated here, April 17th. So this is updated as of April 17th. So over the last 24 years, basically since IWM inception, if you just took your dividends out and spent them and didn't compound them, your average return or your annualized return would be 6.2% a year. If you reinvested those dividends, then each year those dividends the next year earn a little bit more, and then the next year they earn a little bit more. So your total return would be, or your annualized return would be 7.47% per year. Over the last 20 years, you can see pretty similar returns annualized. Over the last 10 years or more recently, the returns have been a little bit worse. So over the last 10 years, you're getting down into that below 7% if you're reinvesting dividends, below 5.5% if you're not reinvesting the dividends. Over the last 5 years, below 5.5%, and below near 4% if you're not investing the dividends. Over the last 3 years, you actually had a negative return. Total return was about minus 13% or so for like total return. If you just held for the last 3 years, you'd be down about 13%. But over the last year, had a bit of a bounce including dividends, of about 10.5%. So what does that mean for the long-term investor? Well, if you could get that 7.5%, which the IWM has produced over the last 20 to 24 years, if you invested, let's start out with, say, $10,000 that you invested with to start, and then you added $500 each month over 35 years, you would have invested a total amount of $197,000, but because of the compounding effect, you would end up with $708,000 after 30 years. Just for comparison, the S&P 500, we have a longer track record for it. So over the last 100 years, it's averaged 10.5% per year, or that's the annualized return. So that would have produced a nest egg of close to 1.3 million. So quite a bit of difference, even going from 7.5% to 10.5%. That 3% extra per year makes a really big difference. Let's look at the biggest up and down years. A lot of them came during the tech bubble of 2000 and around the financial crisis. And then also after big crashes, you also tend to get some big rallies. So you'll tend to see big numbers either to the upside or downside centered around these major crashes and the follow through that happened after. So 2008, one of the bigger down years for the Russell 2000, minus 34%. And then you can see some other rougher years. But then we also had some really good years. So coming out of that 2000 bottom after the crash, we started moving up almost 48% to the upside. And you can just see a list of some other really strong years. 2009, again, coming out of the financial crisis. 2009, 2010, really strong years, up nearly 30% those years. So just interesting. You can see the total returns by year. So these are based on the Russell 2000 ETF. And you can just see every year. So if you just invested from the start of the year to the end of the year, this would have been the return. Prior to 2000, we didn't have the Russell 2000 ETF, IWM. So these are based on the Russell 2000 index, and therefore they don't include dividends. Because the Russell 2000 ETF does include dividends. They are paid within the fund, and the index doesn't track them per se. So here's a historical chart of the Russell 2000. You can see I've filtered it out so that you're only seeing moves of 30% or more on the monthly chart. So this basically shows, all the drops of 30% and then the rallies that ensued that were bigger than 30%. So you can see each of these percentages are bigger than 30% because that's the minimum threshold that we're looking at. So you can see these big periods of, we have the big sell-offs, and then we tend to get these bigger rallies, big sell-off, big rally, big sell-off, bigger rally. So it's definitely why I include this chart is because when you look at the average and you say, oh, I should make 7.5% a year, you can see that will not happen. And we also can see that from the yearly returns that they can be all over the place, right? You can have a 20% up year, you can have a down 2% year, a down 20% year, an up 40% year. So it really varies. An average is just that. It's an average of all those numbers, and they could be a really bad year and a really good year, and they all combine to create this average of 7.5% or this annualized return of 7.5% per year. Looking at ETFs to invest in, IWM, a good choice, very popular, high daily average volume. If you're looking for a lower long-term investment option, VTWO, the Vanguard Russell 2000, half the expense ratio of IWM. If you're in Canada, XSU is a good choice. It's Canadian dollar hedged, and the XSMC is an unhedged version. Because basically, if you're in Canada, you're going to be paying Canadian dollars to buy it on a Canadian exchange, but the Russell 2000 is U.S. stock, so it is U.S. stock based. So you have the option to basically hedge off that currency exposure or not. Let's look at how these have performed. So we have the Russell 2000 is the candlesticks here, and QQQ is this turquoise bluish, and SPY, or the S&P 500, is the orange line. So if we go back to when IWM started, you can see it's the overall return. So this does include dividends. So this is not annualized return. This would just be total return, because we're starting here and we're ending over here. So you can see the S&P 500 up 443% over this about 24-year period. The Russell 2000 up 463%, and QQQ up about 501%. So Russell 2000 kind of right in the middle of the mix there. So it actually has performed really well if we go back to 2000. And again, this is because IWM didn't sell off quite as much during the big tech crash of 2000. S&P 500, Nasdaq, QQQ would have been holding some of those bigger tech stocks, which really got decimated during 2000. If we go a little bit shorter periods, then that's when IWM hasn't performed as well. So if we go to the, we can see the 2009 bottom here. Pretty much all the indexes bottomed right about there at the edge of my chart. Now we can see a really big difference. Total return on IWM, 523%, still good, but nowhere near as good as SPY, up 734%. If probably would rather have that extra 200% in your pocket. And QQQ just way better than both of them, almost doubling those returns, 1,505%. If we go off the COVID bottom there in 2020, then somewhat similar. QQQ up about 100%, 97% for the for the Russell, and 83% for the SPY. So overall, over longer terms, they've been fairly equal, but there are periods where one index tends to outperform others. Overall, QQQ has been the biggest performer, at least over the last 25 years or so. And more recently, we can see that QQQ has struggled. So if we go back to this, kind of mid 2022, IWM has just been pretty flat, up, just depending on where we pick a bottom here, up a few percent versus SPY and QQQ, which are up much more. So that's basically the breakdown of how how IWM, the Russell 2000 index, has performed in terms of its annualized returns.